Luke Spajic, Executive Vice President over at PIMCO, of course, Pan-European Credit Portfolio Management. Most base case scenarios at the moment, Luke, seem to be looking towards Greece muddling through, remaining in the euro. What's your base case scenario?
Okay. Well, let's just look at the Greek population. What do they think? 80% want to revise the terms. Same people, another 80% want to stay in the euro.
Yeah.
It doesn't really, no, it doesn't work. So at the end of the day, the Greeks have three friends: the IMF, the EU, and the ECB. That's funding them. So if they can't agree on what to do going forward, then it's highly unlikely that Greece can stay in the euro under current conditions. So the muddling through can happen for a little bit longer. They just receive a lot of capital for their banks. Great, but it doesn't really stop the problem.
So what can resolve the problem at the moment? Do you envisage Greece actually coming out, or do you think the ECB really needs to do something to support the market, take the pressure away so that Greece can remain in the euro?
Right. The way things are stacked up, it looks highly unlikely that Greece can grow into its debt structure. It's probably better served to be out rather than in, because then it can get the breathing room that it needs to. But the way that's done, whether that's orderly or disorderly, is the big issue for everyone else. If it's done in a way that's phased, then okay, you know, we can understand how that can happen. Yeah. But if it's done in a way that happens overnight, or the political system collapses in Greece, then that's just going to be too detrimental for everybody.
What I want to really get to the crux of is what would force Greece out? What would be the snap decision that would mean Greece would have to leave the euro? Would it be a decision on their part? Would it be the ECB going enough is enough, EFSF bailout funds being withheld for June and July?
It's a bit of both. It's like all marriages, when they break down, somewhere needs to take the blame. But it could be a bit of both. At the end of the day, the Greek populace, through the electorate and through the political system, can turn around and say, right, we want to stop this. Or the IMF can turn around and say, we've been monitoring the situation and you have not met the terms. Yeah. We're going to hold back a tranche. Either of those two things can happen. Now, which one comes first, chicken or egg, I don't know. But what I do know is that as things move forward, the growth won't be there to support the debt load, and it's just going to get harder and harder and harder, and it looks more likely they'll be out rather than in. More
likely out rather than in, Luke, but then what about contagion? Contagion is rife already. We're seeing Spanish bond yields on the rise. We've got concerns about bank runs, not only in Spain, but in Italy as well. What can the ECB or indeed the European leaders do to prevent this?
Pretty simple. The ECB can lend an unlimited amount at a penal rate. Simple as that. They can do anything. If they wanted to, and I always talk to my friends about this, they can turn up any given day and turn around and say, we think Spanish bond yields should be X. And they can turn around and say, we'll buy all those bonds at that level. And they can reprice the entire market. They have the ability to do that. They have the balance sheet.
Do they have the legal framework to do that?
Well, they do. They've already started doing it. The S&P program is there. They've already bought bonds in all the peripheral countries. Yeah. They can also do another round of LTRO. Yeah. Third LTRO. Is it going to be as effective as the other two? Probably not, because the second one in particular really took the markets by surprise, the size of it and scale of it. They could do that again. So as far as I'm concerned, if the political willingness to integrate on the fiscal side isn't there yet, and they can't work out how to do it, and it's going to take many, many stages, then the ECB has to step in. It's the only game in town.
You say fiscal union is eventually required at the moment, but as we say, that can't happen overnight. What about a deposit guarantee scheme? That seems to be what is being talked about, European-wide. But how does that help offset concerns about redenominations? If you exit out the euro, the guarantee scheme isn't going to be there.
There's a problem. Okay, so without getting too scary about this whole situation, if depositors feel that their cash deposits in a Greek bank in Athens, that euro is not the same as a euro in Munich or Paris or somewhere else, then you're going to start to see a different reaction. Now, look at the Greek numbers again, as in the opinion polls. 80% think they want to stay in the euro. But at some point, that number starts to fall. And when that number does start to fall and deposit runs start to kick in, then having a European-wide deposit guarantee scheme may be very difficult to implement. So we already have deposit guarantee schemes on a national level up to a certain point, but it gets harder to guarantee it system-wide. So, you know, why would a German taxpayer be on the hook for someone else's deposit? So I think there's a level at which they can go on national guarantees, but a system-wide one will be very difficult to implement. So it may take legislative change, and just like fiscal union, that's a really difficult process. You need to get 17 countries to agree.
So at the moment, it's all about the ECB stepping in to whatever they can.
I genuinely believe it's just the ECB.
US, UK, that's been the haven. Finland, even the Dutch bonds, they've been at record lows. You're saying it's getting harder and harder to find safety. Do you advise still holding these sorts of securities?
Well, I think it's very hard to have absolute views on yields. The best thing is to have relative views on yield. So the way we rank it is we prefer the US over Europe. We probably prefer the UK over Europe as well, but somewhere the UK is in between the US and Europe in terms of the bond markets. The truth is that it's easier for us to understand what the US looks like. It's a reserve currency. We understand what the central bank is doing. We understand when they print money. We understand what their entire yield curve looks like, and they're not contaminated by the stuff that's going on in Europe. The UK, at the same time, has very similar policies to the US, massive QE program, and but it has a lot of links to Europe, a lot of trade with Europe next door. So in that order, it's easy to understand why US is the preferred safe haven still, and why the dollar would be the currency of choice. The other sovereigns around the world that might be interesting, for instance, a place like Norway, true AAA, massive sovereign wealth fund, and it looks like it's miles away from all the world's problems. And obviously you have other parts of the world where they have huge sovereign wealth funds, but they're not really investable for global investors.
A notable other haven has been, of course, German bonds. We're seeing them at record lows once again today.
Right.
What's interesting, though, you've been advocating eventually the move towards a fiscal union. Does that mean eventually we'll see a convergence with German bond yields having to be forced higher as they're going to be on the hook?
Right, and we've just seen on the screens, they are at record lows in 10-year, and you've got Spain moving towards record highs. They are both the wrong price. What I mean by that is that either Spain goes from 6.5 to 7, 8, 9, 10, 11 bye-bye, or they start coming back down again to more sustainable levels. Now, Germany at this current level is implying extraordinarily low total returns going forward for anyone who's a saver or an investor. It's not attractive. It could be if you think that these yields are going to halve again, you'll make a lot of money, but you start moving to a deep freeze. It means that credit markets don't function very well at these very, very low levels. And that's really the scary thing.
Could German bond yields fall further? Do you see a level for them?
They could quite easily, but I think people have to understand, investors must look through this and figure out what is it they're really buying. If they're buying Germany because they think this is going to be an exit plan and the Germans are going to get out and there's going to be a huge bout of global deflation, then you know what, that may be the place you have to go. But if there are intermediate steps towards fiscal integration, which seem to be moving ahead slowly, but there's no grand plan, there's no grand bargain, there's no transformational change to get there. My personal view is I would love to see Europe go all the way and actually integrate fiscally. And then you'll truly see a spread of the risk premium, and you take this whole process of unity to its logical conclusion. If it doesn't work out, then bond yields could go much, much, much lower.
It's been very hard to navigate as a credit investor at the moment, because not only are we just seeing interest rates being manipulated by the central banks, they're now using quantitative easing, they're using one-off LTROs, the long-term refinancing operations. How then do you navigate? You've already said go into the likes of Norway, go into the likes of perhaps US, Canada, the havens. What if you want to be in corporate debt as well?
Well, I run corporate portfolios, and I think for people that are dedicated to the corporate portfolios, and this is where they have to be, insurance companies, pension funds, you can take a lot of regional views. And you can take a view on time. For instance, moving out of European credit into the US credit, which is what we've been doing this year, has been a really good trade for us. There are certain parts of the UK credit market that make a lot of sense. And at the same time, voiding a lot of peripheral credits and a lot of the high beta sectors. Now,
no matter what corporate industry they're in?
More or less. I mean, at the end of the day, it's very difficult to outrun your sovereign. If you're a utility or a bank in a peripheral economy right now, the cost of capital is exploding there. You're so linked to the sovereign, it becomes very difficult to isolate yourself. So what we try to do is, where we do have high beta securities like high yield or loans or bank capital securities, we try and keep that shorter dated. We're trying to outrun, I mean, look, you've got central banks by what they call financial repression, right? Keeping bond yields down. The thing about what Paul Krugman is saying is interesting, is that he's saying that government bond yields are really low and the bond market saying you borrow as much as you like. Kind of. I don't want to go up against Nobel laureate, but what I'm saying is that without QE, without the Bank of England buying, without the Fed buying, those yields wouldn't be there. So these are being, if you like, they're being manipulated. Right? So these rates are not real. Actually, they're not tangible. They have to change. And I think at the end of the day, as a credit investor, you have to outrun negative real rates.
Can you outrun to the emerging markets? Because there might be some attraction there. Which particular countries? Is it those that are more dependent on their own internal demand rather than exports?
So the view that I have on that, and it's very much in line with what PIMCO's been saying for a very long time, if you take a microscopic view and a telescopic view of emerging markets, if you look really far forward into the future, people are convinced, or we're convinced, that the global handoff has to take place. Emerging markets are the future. Sovereign debt levels are very, very low. Productivity should be high. Population growth should be strong. That's where the growth is going to be. So you want to be involved in those markets. You want to be invested there. But when you look at a microscopic level, and that's what's happening now, they're going to get contaminated as well with all the volatility, and investors will take pain in those trades because they're highly correlated. But I think it's trying to get a balance between the two, having this structural tilt towards emerging markets, especially on the credit side, which we think is real and tangible, and then trying to balance that with making sure your hedges work when the world goes a bit funny.
And in terms of hedges, where are you looking to hedge? Is credit default swap, bond insurance, is it working as a tangible hedge anymore?
It is, and we've had some degree of success with all of those instruments. But I think really the true safe haven is probably going to be US Treasuries.
Okay, so keeping an eye on, of course, the US government debt. Luke Spajic, thank you very much indeed, Executive Vice President and Portfolio Manager at PIMCO.